Welcome back to Grown Quality. My name is Elian, and we've got another week in the books. And boy, was it a difficult one. We saw PayPal basically sinking through the floor, going from about $67 to, well, I think it's now in the $61 range. It dropped about 10% in a week. So let's find out what happened there. But we also saw Shopify just gaining 10% over the last 2 weeks. So what's going on with that stock? Because it seems as if there is no news regarding it. Now, all of these difficulties came on the back of some what seemed to be favorable macroeconomic data. We got a good CPI report, we got an even better PPI report. But the dot plot showed a bit of a different story. Now, let's dive into the news from this week from the Grown Quality portfolio and also from some stocks on the watch list like Celsius and Tesla, because what wouldn't be a week for Tesla without many major news articles? Okay, so starting with PayPal, because as of filming this, the stock is currently trading around the $61.50 mark. And that comes after last week when it was trading around $67. So that's a very big drop, of course. Now, what happened is highlighted here in this news or this headline. And it says PayPal's competitive challenges are back in the spotlight. Now, what are those challenges exactly? Well, specifically developments involving Apple and Affirm and MasterCard. This just highlights how the competitive world of the digital payment has become, PFA's Jason Kupferberg wrote in a note Wednesday to clients. PayPal shares declined Monday after Apple announced a new tap to cash function that will let users of its Apple Cash Wallet service send money to other iPhone users just by tapping their phones against one another. And PayPal stock has continued to drop in the two sessions since. Now, this Apple news came from the Apple event on Monday, and the headline was from Tuesday or Wednesday. Now, I can already tell you, Thursday it also fell a lot, and Friday, well, today it looks to also be declining. But as the article continues, MasterCard will be introducing passkeys to replace passwords. Kupferberg wrote as he reiterated his neutral rating on PayPal's stock. While this initiative is long dated, it reinforces the fact that competition for PayPal's core checkout button and for PayPal's new Fastlane service targeted at cash checkout could continue to intensify. Elsewhere, there's been optimism about the Fastlane cash checkout service, including from Mizuho analyst Dan Dolev, who upgraded PayPal share based on the thesis in May and said that growing awareness of the opportunity there helped propel PayPal shares to their best day in months late last week. This is where the stock traded to $67 range, also after the conference Alex Chris, he participated in. PFA's Kupferberg, for his part, wrote that PayPal's management has been making sensible strategic moves, but that the company continues to operate in a highly dynamic and complex competitive landscape, which could ultimately impede the magnitude of top line reacceleration needed to catalyze significant multiple expansion. Now, I agree with a lot of these articles, but this is one where I don't fully agree with. And I'm going to start at the end with the most easy part, and that is the reacceleration needed to get a new multiple expansion or get re rated, um, however you like to call it. I don't think that's true. I don't think it has to reaccelerate its growth. PayPal is currently trading at a 16 PE, a 16 forward PE, and that's just extremely low. That's for a company that has no moat whatsoever, isn't growing, and we know that's not true. Although there might not be too much of a moat for PayPal, because, well, there is a lot of competition, that's true. It's not true that it's, in my opinion, it needs re-acceleration in its growth. I think the 8% revenue increases year over year are perfectly fine as long as they know to outgrow it sustainably and predictably with their EPS. And that's more where the issue lies. That's what they haven't been able to do. And this has taken away the confidence of investors, of Wall Street, of the institutions, in my opinion. And that has made the stock tumble to a 16 forward PE. Now, in order to get re rated, they just need to get that predictability back. And if there's competition or not, that doesn't really matter for the predictableness of the stock. It just needs to do what it should do and stabilize. That will be enough for a slight re-rating. If the company re-accelerates, that's where you can see a far more increased uh, re-rating, in my opinion, and a far greater multiple expansion. But as it stands, just by getting more predictable, more continuous, steadily increasing EPS numbers, it can already get a slight multiple expansion and re-rating. So then for the Apple news, I don't know how significant this is. I mean, I'm in Europe and here you can basically everywhere where you can pay by card, you can just pay with your iPhone. It's the same. It's the tap to pay. It already exists. It's so having it as a function by holding two phones together, I'm not sure how much competition that's gonna bring to PayPal. I'm not gonna say it's gonna bring none, because of course when you want to split a bill or whatever these kinds of things, maybe you have a tiny company that just has a showroom uh, in its house, like in the garage. For those things, it's useful. But are you really stealing that much revenues or that much market share from PayPal? I'm not sure. I don't know how serious this has to be taken. But of course, it does highlight the fact that there's competition in this market. But I actually think there's something else that happened that is, I'm not going to say more of the issue, but it's amplifying the issue. It's just making it's adding to it. And that's the conference we had at the beginning of the week where Jamie Miller went, the CFO. And basically, what's happened is that last week, or yeah, the week prior to this week, we had Alex Chris going to a conference, and he was so determined. He sounded so sure of what he was doing, how he was leading the company. I also made a video back then that I didn't see the company going back under $60. Well, we're a week later, and it's not looking all too good for that statement. But we'll see what's happening there. I'm not gonna back out of it. I really like what Alex Chris is doing. But Jamie Miller was at a conference and she didn't sound as determined, as sure, as well a rock hard, tough leader as Alex Chris was. She was very much into praising others, which is, of course, a good thing. You are a team, you have to praise others. But what I was lacking was a bit of that determination of we're gonna make it, we're gonna innovate, we know where to go, we know what to do, we know how we can improve this business. And she was more on on pleasing Alex Chris, on uh, highlighting how many incredible leaders they have brought into the company. And I just missed a bit of that. How do you say it? That spirit of wanting to win, um, and I think that added to the annoyance of the competitiveness of the market. Then we have Shopify, and Shopify didn't really have news. Better said, they had no news. But what it did have was a 12-day win streak. Now, yesterday, unfortunately, this got broken, but 12-day win streak without news. That's quite impressive. But then again, we know Shopify. It's a very high growth stock. It's grown their revenues for 25 or by 25% for the last 2 years and 45% for the last 5 years. And That's incredible growth. So, seeing that the stock has dropped as much as it did makes investors want in. I mean, I bought a little of it myself on the dip and hoped it would stay all around the high 50s dollar mark for a bit, but it didn't. And I think that that's what you are seeing now. I think the stock, well, the drop in the share price created investors to get their attention and to want in, but maybe wait for a bit lower prices because the stock can be volatile. However, it didn't drop and it was at a reasonably good price, especially seeing the history of the stock. So I think that that's what happened. Basically, a FOMO, yeah, well, just FOMO buying, but 10% up in 12 days. I'll take it. I think it's a little more actually. So that's good. But yeah, I think it's just straight FOMO. Now, then we had Celsius, and Celsius is one of the, well, I'm gonna say one of the most incredible growth stories in the markets right now. There are some others, Elf is one as well. But Celsius, well, they have fallen off a cliff and quite badly. Now, what happened was a conference. Again, a conference. And after the conference, this is what happened. So the headline says Celsius falls after brokerage cuts price targets on Pepsi inventory reduction. So that sounds quite bad, doesn't it? I mean, Pepsi holds most of the inventory of Celsius and they are cutting inventory. That doesn't really sound all too great on the face of it. But there are some underlying things going on, which I will explain. But first, brokerage Morgan Stanley cuts price target to $68 from 75, and Wedbush from 83 or to $83 from 85, and Stifle from or to 85 from 95. Now that's three price cuts in 1 week without earnings. That's notable. So what was said was we believe the bulk of H1 inventory cut reflects that Pepsi's inventories of Celsius exiting 2023 were too high for the recent sales rate. Okay. Stifel says further meaningful reductions are unlikely as Celsius inventory is held by Pepsi nearing equilibrium since distribution changeover in Q3 2022. So that's what they said and why they changed their price targets. The last part of it was that Celsius management at a conference on Tuesday noted an impact of 20 to 30 million on Q2 revenue due to further inventory reductions from its primary distributor, PepsiCo. Now, this is a weekly chart of Celsius, and for the last 3 weeks, it's been tough. It went from about $95 to mid 60s again, low 60s even. That's a tough ride in three in 3 weeks. I'm gonna tell you. I mean, to stomach that much of a drop in such short period of time, that's tough. But on the other hand, we have to acknowledge where the stock came from because 4 years ago it was barely above $5. I mean, the stock has over tenfolded in a few years. The stock is growing immensely. So, although the recent drop is very harsh, the stock is growing very rapidly. So, that brings a lot of volatility. Now, when we look back at the brokerages or the institutions and what they said as to why they cut their price target, it mostly came down to sector slowdown. This was also mentioned in the conference. There is a sector slowdown happening, and it is somewhat impacting Celsius. However, this reaction is excessive. I mean, from 95 to the low 60s on a tiny slowdown in the sector, that's a bit much. However, the inventory reductions from PepsiCo, that is what seems to fuel investors. By investors, I mean basically mostly the street, because they are the ones selling in and out as rapidly as is happening now. But that's confirming the investors' ideas that the sector is slowing down, and thereby confirming the ideas of troubles. Now, in reality, how Celsius frames it is that PepsiCo, well, they just bought a bunch of inventories, in my opinion, just to have enough and to make sure they aren't getting stuck without inventories. But now that they know how the distribution works, what the demand is, they can right size the inventories for the certain number of days on hand. And if that number is slightly lower than where days on hand is currently, then you're gonna get then you're gonna get some right sizing of that. And that is how it's currently framed as to what is happening by Celsius. Now, that isn't much of a problem, but it is creating a bit of fear. And if the stock will continue to drop, I may buy a little. Might. I'm not sure yet, but I may. Now, I'm gonna assume you are familiar with the phrase that there are two things certain in life, and that's taxes and that's death. Now, I think we can add a third thing to that, and that is controversy around Elon Musk and Tesla. Whatever they do, there's controversy around it. Even if it's justified or not, let's leave it in the middle. There is always controversy around it. And the latest being the pay package of Elon Musk and the vote surrounding it. Also, the relocation from being incorporated in Delaware towards Texas. But they had news around it because that vote came in this week, and I suspect you may already know it, but I'm going to go over it really quickly anyway. But the shareholder, well, as Musk posted it, Tesla shareholder resolutions are currently passed by a wide margin, both of them. And that was the pay package, and the orange line we see here. That's how much votes Elon Musk needed to win. And then the blue line is the votes in favor, and the gray line is the votes against. And we can see a sudden spike in the votes in favor of the pay package, just as we can see that sudden spike in favor of, reincorporating in Texas, basically. And I've seen a lot of discussion surrounding this. So I just want to take part of it, basically, because I think there are multiple angles we can view this in, and I think all of them have something, well, going for it, basically. Okay, so there are, well, four main arguments I have seen being made. Well, three in favor or three against the pay package, and one in favor of it. Um, so I'm gonna start off with the negative, the negative takes on it, in order to end it with a positive note, or the most commonly used positive note I see. So the first case against it is how dilutive it would be for shareholders. Now, this is something that's been named by many institutions, but I can push back against it by saying that money managers aren't really that well known for being, well, thinking about someone else's pockets, thinking about other things than their own pockets. So if Elon Musk gets such a big pay package, it can dilute their stake in the company, and, well, that's not in their best interest. So they're going to vote against it. I can see what they are coming from, but I can also very much relate to the latest or the last argument I'm gonna make. Now, because this is dilutive, but then again, he already had the compensation package. The second argument is that it's excessive. And I truly, truly agree with it. This is excessive. $56 billion is excessive. But then again, we have to also acknowledge the fact that it was set based on targets which seemed unrealistic. So they said, okay, we'll just do it because you're not going to make that anyway. Then he did. The third one is the performance of the stock. And that's been bad. I mean, the stock is down over 50% over the last 3 years. And of course, that's cherry picking because prior to it, the stock is up by quite a lot. The stock is up immense over the last 5 years. But over the last 3 years, it's down. And that's what Elon Musk gets punished for. Now, I have an opinion of my own in this. And that's basically connecting with the fourth argument that I see going around a lot. And that's that a contract is a contract. This contract was signed in 2018. That's when the compensation package was structured initially. And then 6 years later, after the stock has fallen over the last 3 years, you're going to take it away. That's weird. That's wrong. He is compensated for work he has done. And that's the way it should be. Now, I think the compensation is excessive. But so were the targets. I think the pay is dilutive, but it was so already. And I think contract is contract, and you should honor it. And now they have to, well, now that they have the votes in favor of it, they have to gonna take it through court again and seek, well, seek permission for it or get compliance on it from the court that initially voided his original pay package. So that will be interesting. Now, I am very happy to hear your opinion on any of the items I mentioned here today. And with that being said, that was it for this video. I hope you have enjoyed it, and if you did so, please like this video and subscribe to my channel. And with that being said, thank you for watching